Good evening, Murugesan sir.
Good evening. Ready.
Yes, sir. Yes, sir.
Okay, I think we can start our, okay, another 1 minute we can wait, some of them.
Yeah, okay, sir. 1 minute wait.
Yes. Oh, so many people are logging in. Very good. 89. Okay, good evening, friends. Welcome back after a break. Okay.
Good evening, sir.
Good evening. So, are you all seeing the screen now? Yes, friends. Yes,
Yes, sir.
friends.
Yes, sir.
Okay.
Yes,
Okay,
sir.
friends. So we have just come up to risk management. Our final attack we'll make on risk management. Tomorrow we'll attack balance sheet management. Then we will leave you free because you should revise. Okay. Don't get confused with too many things. Now, last minute, only read the bullet points. Okay. You should have. Otherwise, so many people know they at this last moment they read big books. Now, this is not the time for reading big books. You'll be confused. So my sincere advice is focus on what we discussed during the, yes, I think recently conducted crash course plus this, okay, will help you to sail through very comfortably. Okay, now one more risk we are going to face, how to tackle the risk. The very important risk for a banker is interest rate mismatch risk. What is that interest rate mismatch risk? You may wonder. What is that interest rate mismatch risk? And especially a banker is facing this risk. I think you all note down. All our deposits are locked at fixed rate or floating rate. One of you can answer. Our deposits, term
Fixed
deposits.
rate.
It is all locked at fixed price. Very good. But all our advances mostly are locked at fixed or floating.
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 Now I will ask a simple question. When floating rates are better, supposing when floating rates will be better, when fixed rate will be better. From bank point of view, okay, we'll think from bank point of view. When floating rates are better, yes, when floating rates are better, the interest rates are going up, floating rates are better.
Sir, when
When
interest
fixed,
rates are higher than fixed rate, floating rates are better.
that is why. Suppose you are accepted for fixed rate, but bankers, it is opposite for the borrowers. Banker and the borrowers will be opposite. For the borrower, house loan borrower, imagine. The house loan borrower, sometimes he will opt for fixed rate. When fixed rate will be advantageous for him, if the interest rates are going up from borrower point of view, he'll be happy if he is given fixed rate. The same borrower, when the interest rates are coming down, he will tell, sir, fixed rates are not good for me. Why don't you give me floating rate? Because now floating rates are lesser. So same way, banker also faces the problem. All our deposits are at fixed rate. That means during the tenure we cannot reset. That is the meaning of floating rate, fixed rate. During the tenure of the contract, we will not reset the interest button. But in advances, loans, especially mainly in housing loan and other loan, we are linking to a benchmark rate. So whenever there is an increase or decrease, it will be floating. So this risk is called as what? All our assets are at floating rate. All banks are liabilities are at fixed rate. So this create a problem, interest rate mismatch risk. Now the next question they will ask is, what is the derivative product to manage this interest rate risk? This is a question. So the question has come here. So answer is here. The question is here, answer is here. The risk on account of assets at floating rate and liabilities at fixed rate is called interest rate mismatch risk. Especially all banks are facing this risk. Okay, to manage the risk, you have to use banks are also using derivative product. I think all of you know, remember, derivative products are called as risk management tools. Sir, what is a derivative product? In other words, it's a hedging tool. Derivative products are called as hedging tool. Other name, hedging. Okay. Why they should hedge? Because sometimes exchange rates are floating, interest rates are floating, prices are floating. Prices, international commodities, prices are floating. Floating means today one rate, tomorrow one rate. Especially for dollar, okay, especially for American dollar, every day there will be 1,100 rates. 9 o'clock one rate, 9:30 one rate, 9:40 one rate. So this rate may affect a particular customer. So he has to fix the rate. So that is called hedging. Okay, the floating rates, making it fixed is called hedging, and there are derivative products. Derivative product means all are hedging tool. So similar way, banker also has to hedge their risk. Banker is facing a risk, you know. So that risk is called as IRS. This question they will ask because even HDFC bankers once landed in a problem. So they manage their risk, and all bankers are having FCNR risk. What is the FCNR risk? I will come to that. IRS. What is IRS? Interest rate swap. Okay. What is the interest rate swap? It's a deal outside the purview of your deposit advances portfolio. It's a separate derivative deal that will help the banker to convert floating rate exposure to fixed rate and vice versa. Fixed rate, just now we discussed, sometimes fixed rate will be better, sometimes floating rate will be better. You know when it will be better. But you cannot break the rate with the actual lender or borrower. Now you can change it by entering into a derivative product, separate derivative product that is called IRS, popularly called as what? Interest rate swap. This they will ask how to manage the interest rate risk, how to manage this. Immediately you think of IRS, interest rate swap. What does the interest rate swap will do? They will ask, you tell them, the answer you click, it will help the particular yes corporate or the banker to manage exposures in floating rate to fixed rate, converting, managing through what? Converting exposures. It may be a deposit, it may be a liability, it may be assets. No problem. The exposure means it includes everything. The exposures in floating rate to fixed rate exposure to floating rate to avoid interest rate risk. Interest rate mismatch risk. Okay. So this question they will ask, you remember. And in FCNR also we are doing this. FCNR also we are doing this. Why FCNR? There is a separate question I have forgotten. Note down. FCNR is also we are facing the same risk. Okay. Why we are facing the same risk in FCNR? They may ask a separate question. What is the risk a bank faces in managing FCNR portfolio? Answer is same. Interest rate mismatch risk. What is the interest rate mismatch in FCNR? FCNR, you can note down if you are interested. Okay, this I have not given a question, but by chance they have given a question. If they ask a question, you should be able to answer. In FCNR, what is the issue? The issue from the bank point of view, we are contracting at fixed rate. All FCNR deposits are contracted from the NRI customer at fixed rate. What does it mean? During the tenure, you will not change it. But what do we do with the FCNR deposit? We are not swapping. We are giving loan to our exporters. That is called PCFC. Pre-shipment loan we are giving. Post-shipment loan we are giving. But that will be at floating rate. Okay, supposing floating rate keeps coming down, LIBOR or some other reference rate keeps coming down, we'll have to charge necessarily less for our exporter. But you already agreed to give so much fixed to our NRI customer. Then it will become a loss. Agreed or not? This loss, how we can manage? Again, IRS. Remember the product? Interest rate swap. What is swapping? Fixed rate to floating rate to fixed. Okay, so that you keep in mind. That is 71. 72, another risk is there. Hersat risk. Hersat. Hersat. Hersat risk. This is on account of forex settlements. Suppose in the forex settlement, America and India and India and Japan, they enter into a deal and they have to settle. Sometimes, there will be time zone difference because geographically, the time zone difference will be there. On account of the time zone difference, sometimes, by the time they have to settle, the bank gets closed, or by the time the deal in India gets, the value date, there will be one or two like that. So the delay on account of validating, on account of time zone difference, on account of that, any possible loss to a bank is called Hersat risk. It's a technical name. It's an odd name, so they will ask. What is Hersat name? The definition is a form of settlement risk. Yes,
So
friends?
another name also, temporal risk also the same.
Temporal risk or settlement risk.
Which one?
Temporal risk also said to be Hersat risk or settlement
Yes,
risk, no, sir?
no,
Settlement
this is
risk.
Hersat risk is not a settlement risk. It is on account of time zone difference. Okay, it's a form of settlement risk only, but it is on account of what? The main factor for this Hersat risk is the differences in time zone, because your geographical locations are different, especially in inter-country, the intercontinental or cross-border transactions. Okay, it will rarely. But why they are asking, sometimes it's a fancy name, the odd name, so the most of the questions will be on what is Hersat risk. Immediately remember, on account of the loss, on account of possible loss. I don't tell always it will happen. The possible loss on account of settlement in owing to time zone differences is called Hersat risk. It's a form of settlement risk. It's a form of sub-form of settlement risk. Agreed? Okay. And the name is Hersat. Okay. Now one more question. All questions I will give live. If maturing assets in a time bucket, sometimes maturing assets mean immediately remember inflow. Note down. Maturing assets mean inflow in a time bucket, maybe 1 year bucket or 30 days bucket. Okay, there are 10 buckets, maturity buckets. That we'll discuss in AL, and that is balance sheet management tomorrow. But remember, it becomes a risk. What is the risk? Risk is in this today only we are going to finish risk. If maturing assets mean inflow in a time bucket more than maturing liability mean outflow. Maturing liabilities are more. Okay, maturing assets in a time bucket more than maturing liabilities in the same bucket, then it becomes which risk? Then it becomes
Embedded risk.
Funding risk. Gap risk.
our kids are also interested. Okay. Our kids are again, I think they are after us because for them dinner time. Okay. So okay. Very good. So this risk is called as gap risk, friends. This is not mismatch risk, gap risk. What is gap? Now the gap is positive or negative? Positive. Why positive? One of you tell.
RSA is greater
Because
than
asset is more than
Asset
RSA is greater than
Correct.
RSL.
Inflows are more. This is RSA. Okay. RSL, I think in balance sheet. Don't worry. So here inflows are more in a particular bucket. So outflows are less. Okay. Then it becomes gap risk. it is a positive gap. Positive gap means we have money in our hands in that bucket. Sometimes it will be negative. It will be negative. What is a negative? You maturing assets in a time bucket less. Okay, 1 year time bucket. Maturing assets are less and maturing liabilities are less than maturing liability. But the outflow of funds during a particular bucket becomes more. Then it becomes again gap risk only, but it becomes a
Negative.
negative risk. It's a negative risk. Why negative? It's a negative risk. Why negative? The gap analysis will do in balance sheet related question, but here risk becomes a risk management. So the gap risk, okay, negative. Negative mean, okay, what will happen when the interest rate? Positive risk mean when more inflows are there, positive, more outflows are there, negative. Because we have to arrange the funds now. When there is a negative risk, we have to arrange the funds. Positive risk mean you have to invest the funds. Positive risk mean we have to invest the funds. Negative risk mean you have to procure the funds, arrange the funds. That will create a problem. What is that problem? That is in management, balance sheet management. Wait. Okay, till tomorrow. Now 75. Which of these not, because these are all risk management oriented questions. Which of these is not one of the three pillars under Basel II? And Basel II, I think there are the three main pillars. What is the main pillar? No. First pillar, capital adequacy. Very good. Supervisory discipline. That is supervisory discipline mean because the regulatory authority should be strict. Otherwise, things will go wrong. That is supervisory discipline. Okay.
Option
Risk-free
C.
business
C.
strategy.
C. Risk-free business strategy.
This is not a correct. Very good. Abba. Very good. So 76. Which of these is not an advocated approach for credit risk management? Credit risk management, three approaches. Operational risk management, three approaches. Similar way, market risk also, most popular are two approaches are very popular. So which are the approaches popular? They will give list. Now which is not relating to credit.
Basic indicator. Basic indicator.
BAA approach is actually belongs to operational risk management.
Operational risk.
Yes. These three are credit risk. These three are credit risk. Very good. So this is answer is B. Odd man out is B. Okay, odd man out is B. Oh, why the screen is moving fast? Basel 3. Basel 3 is implemented as on what day? Basel 3 is implemented as
31/3/2019.
B option, sir.
Great.
B, sir.
21/3/2019.
All of you are
2019.
19. Okay. Now, hybrid debt means what? It qualify for what? Hybrid. Sometimes they will use the word hybrid. Hybrid means what?
Half fixed, half
Combination
floating.
yeah, not floating. Neither a debt nor a equity. It's a combination of debt and equity. Okay. Why somebody is moving the screen? Okay. Yes, anybody is given access to the screen? Okay. Why? How it happened? Anybody is tampering the screen?
Debt convertible to time.
Debt convertible to equity.
Tier 2.
Okay. The first blank. Tier 2 only. Debt convertible to equity. Okay. Tier 2. Yeah, debt with options of annuity cash flow. That is not the meaning of hybrid debt. Okay. Yes. High cost debt. That is not hybrid. Hybrid mean don't think it's a cost
A is
is
the
high.
answer, sir.
Yes, A is the answer. A is the answer. So answer is A. Okay. Now 79. Market risk.
Sir, hybrid debt means
Which one, boss? Hybrid debt mean combination of debt and equity. That is convertible debentures or convertible shares. What is convertible share? The share can be converted to equity.
Easily converted into
The share can be converted debt instrument. Debt instrument can be converted to equity instrument at the option of the investor. That is called hybrid debt. Hybrid debt means what? Here the focus is hybrid debt. What does it mean? A bond or a debt instrument can be converted to equity instruments. Okay. Sometimes you are unable to pay the loan. Some people, they will convert it to equity. Equity means need not be repaid. Equity need not be repaid. but the debt need to be repaid. So equity mean it strengthen the base, but both are sources of finance, either debt funds or equity fund. That is called hybrid debt. So the hybrid debts are always recognized as in the bank books of the bank tier 2 capital only. It will not be a tier 1 capital. Okay, understood? Okay, we'll come to that tomorrow. Okay,
Sir,
17.
one without with what is volatility risk?
Which one, boss?
Volatility risk, sir, means
Volatility means fluctuation. Sometimes
Vol-
it will be volatile. Volatility risk. Okay. Volatility risk means some assets always will be fluctuating in value. Okay, that also I am giving a law. Then that will be controlled by value at risk. Value at risk means to manage volatility in exchange rates, volatility in interest rates. Okay, that also we am giving questions. 1 second, wait. That is called as what? Because some shares, the share prices are volatile. Suppose you invested in share, Reliance share you have invested. Today it is 800. Next day it is becoming 750. Next day it becomes 720. When the rates are going high, okay, it's a profit. When the rates are going low, it becomes a loss. So the prices in marketable securities, sometimes it keeps on changing. That is actually a market risk. Okay. So that also you have to manage. Volatility.
sir,
Market.
then reinvestment risk and volatility is same, huh? Then connection is there.
The reinvestment is whatever you are getting return, again you have to reinvestment risk mean you are getting a return. The return instead of withdrawing, the return also you are adding compounding at a fresh rate. Sometimes the interest rates are coming down, your reinvestment will get a lower return. So that is called reinvestment. What is reinvestment? Whatever return you are getting, you are not withdrawing the returns, you are adding to your capital. So you are again investing. That is called reinvestment risk. Okay. Sometimes because of changes in the interest rates, your yield will be affected. So that is reinvestment risk. Okay. There are different type of risk, friends. Believe it or not. So, but mainly the FAQs, what are the risks mainly from bank point of view? Because all risk management in banks, they will ask. Okay, hybrid debt you understood. Now market risk will be measured and through normally SD approach. SD approach means standardized duration approach. Now in the internal model
Both
approach
A and
also,
B, sir.
yes, both A and B.
A and B.
Now they are developing this model. Okay, internal models also they are developing, and the standardized duration approach is also, yes, that is a standard. I think how you have to manage, we'll see. Okay, that is either either ARB, not both A and B, either ARB. So the D is the answer. But that is market risk. Operational risk, only three measures are there. BIA, that is called BIA approach. This is an old one. Now most of the banks are under a standardized approach. Now advanced AMA approach. AMA approach also I am giving questions because it's a little complicated. The probability of occurrence. Okay.
So can you show the slides,
impact
the
in
79? Can you show the
79.
slides? Yeah, one second. Just for a second.
79 market risk, madam. Market risk will be managed through mainly the popular approach is standardized duration approach. Now they are advocating internal models approach also. So the correct answer is either A or B. That is market risk has to be managed.
Okay, thank you.
Yes. Okay, now 80 operational risk, how it will be managed? Because every bank has got operational risk. What is operational risk? Inadequacy in our own systems and procedure. Suddenly we are changing the procedure and the staff are not kept updated and they are not aware. Ignorance is not the excuse. Because of inadequacy in implementing new guideline or changed guideline, there is some deficiency in our working. So the loss of income. Okay, all these constitute operation risk.
Any of the above, sir.
Yes, any of the above. That is D. Answer is D. Okay, now Basel III introduced dash to manage short-term liquidity stress in banks. Now in the
Liquidity coverage.
LCR, great. LCR is the new concept. That is, we'll discuss in balance sheet management also. That is, you should have high quality liquidity assets to manage any high
Net
quality.
cash outflows of 30 days. 30 days.
30 days. Correct. You are very advanced.
Sir, both
Correct.
B and C are correct.
Yes. Both B and C are.
So
Okay.
net stable,
But
they are asking liquidity.
NSFR is not for.
C for
Short-term liquidity.
it is for long term, sir.
Not for
Long term.
So it's a long term,
not
sir,
for-
net stable.
Yes, it's a long term. So
Yes,
LCR is the correct
Asking
answer.
short-term liquidity.
Yes. It's a short-term liquidity. The question is normally within 30 days. Normally within the stress period. Supposing something happens, the critical period is first 30 days. So during the first 30 days, we should have a contingency plan to manage the liquidity risk. That is called now Basel III is advocating LCR. The LCR should be how much and all we will discuss. Don't worry. The LCR should be at least equal or more than 1.
Then 100.
Yes, the liquid assets should be high quality liquid assets, not just yes, all high quality liquid assets should be more than 100% of the expected net outflows. The gap in first 30 days. Okay, what is the gap and all? Just wait.
So
Okay,
liquid.
friends. Liquidity risk means inability to meet the expected outflows. Supposing there is a sudden withdrawal from SP account, sudden withdrawal from term deposits, current account, but the bank is unable to, because the bank has committed to allow not only, yes, current deposit, the current deposit means CASA. CASA anytime they can withdraw. But sometimes in term deposit also, the premature closure, embedded option, that is also called embedded risk. That is embedded option is there. Embedded means the depositor has the right to close the deposit before expiry of the contract period. Then when so many people are withdrawing, that it becomes a funding risk, not a fund. Yes, it's also a funding risk, or it is another word, is a liquidity risk is a part of funding risk. Liquidity risk means you should be able to arrange funds to meet the expected outflow. So the liquidity risk, if you do not tackle, it will damage the image of the bank. The image of the bank will be damaged. You should have seen so many cooperatives bank in trouble. Okay, some run in the bank. So that is why Basel III told we should have LCR mechanism to manage liquidity in the short term duration, short term liquidity stress. Okay,
Sir,
first 50 days.
So this is what is a haircut, sir? Haircut, sir.
Yeah, haircut. Haircut is already haircut only on apply on collateral pass. Collateral and HQLA. HQLA it will appear. Now tomorrow we'll discuss. And which how much haircut on HQLA? HQLA level 2A, level 2B. There are level 1. Level 1 assets will not undergo any haircut. But level 2A, 2B, that is HQLA, high quality liquid assets, will undergo haircut. Okay, to meet LCR. That we will discuss, I think, balance sheet. Don't worry, balance it later. Supposing tomorrow, I think you are also doing treasury. So tomorrow, by this time, you'll have got full idea about BFM. Those who are not regular, some of you may have missed regular classes. Some of you may have joined only for this quick course. Okay. So all of you will be benefited because the quick revision will help you to update yourselves. Okay. Some of you are, I am happy you are well updated. But some of you, those who may have missed the regular classes, now at least at the these 2 days, you are going to be benefited. Then you will we'll share all this presentation with you. Don't worry. Okay. Now 81, Basel 3, okay, this is over.
There's a counter cyclic buffer, please, sir. It's a counter cyclic buffer.
Yes. Counter cyclical. Okay, that is okay. That is in earlier question or which question, Bas?
Earlier question, sir.
Earlier
Option.
question.
What is
okay, net stable funding we understand. Counter cyclical buffer in the sense when banks are doing good business. Now, right now we'll have more provisions that is floating provision, or voluntarily you are creating provisions. Okay, supposing there is a bad time like Corona days in the future, so these so many accounts may become bad. So to manage a possible contingency or a huge loss that may happen to the bankers or especially to a particular bank, sometimes they are permitted to now build up counter cyclical buffer provision. That is accelerator provision, this voluntary provision, so many provisions. Okay, they are eligible to make in more than the mandatory provision. There are mandatory provision mean as per the law, as per RBI guideline, you should. What is the counter cyclical provision? When you are doing good business, we will make some provision still more, so that will manage our. So this answer for this question, this is not the answer, but is one of the choices they will give. And capital conservation buffer is that will not manage your short-term liquidity. Just to okay, 4 choices they have to give. Sometimes while selecting the choices, people get confused. The main problem is,
Can
yes,
you
boss.
repeat stable funding ratio, please? Net
Net,
stable.
net stable funding ratio. Just wait, madam. Wait. Okay, net stable funding ratio. It's a balance sheet related. Okay, it's also all are interrelated, friends. All are interrelated. What does it mean? Net stable funding ratio mean the core funds. What is core fund? Current account SP is not a core fund. Please remember, current account, SP account is not a core funds. We cannot rely upon. Using current account and SP account, can you give housing loan? Just you listen to my question. Suppose you have got SP account and current account. Using the current account balances, savings bank account balances, can any bank can give? Okay, you understood the question? Can any bank can give housing loans? Because
No.
housing loan is a long-term
No, sir.
exposure. Okay, it is a long-term assets. But long-term assets are financed by short-term liability. So it is a deviation. We are not managing the funds. So this Basel III tell the stable assets mean normally long-term assets should be funded by long-term liabilities. The long-term assets should be funded by long-term liabilities. It should not be funded by short-term liabilities. That will create a problem. That is why NSFR, net stable funding ratio. NSFR, it should be more than 1. It should be equal to 1 or more than 1. Then only banks are safe. Okay. So all these parameters are introduced in Basel III. Okay. Now question number 82 is LTV stipulated. Now is an interesting question. Okay, it is okay. Look at the question. LTV mean loan to value stipulated will be dash when the risk under the loan is dash. 2 blanks you have to fill up. So which blank will be better? Okay. LTV stipulated will be okay. Uniformly, this is not applicable. It will be LTV stipulated will be higher. Okay, loan to value you can disperse more. Okay, suppose housing loan, when the risk under the loan is lower, the LTV will be higher when the risk is lower. Okay, the LTV will be lower. LTV will be lower when the risk is higher. When the risk is higher, that means you are reducing the loan. Now here you see LTV stipulated will be higher. They are giving more loan. That is margin, less margin. When the risk is lower. Okay, understood. The LTV means yes.
Option
Answer
C,
is
sir.
no,
B,
not
B.
C.
B,
B is
sir.
the correct answer. B
Option
is
B
the
is
correct.
49.
LTV stipulated will be, LTV means what? How much loan? LTV stipulated mean immediately remember, LTV stipulated higher mean margin is lower. Margin is lower. That's the opposite meaning. LTV stipulated higher mean, okay, first you apply higher. Supposing higher.
But sir, in that case of housing loan, when LTV not more than 80%, it was risk weighted was 35, and more than 80%, it was 50.
Yes, correct. When the LTV is not more than 80, because you are not dispersing more than 80. So the margin available is 80, 20. So the risk is margin 20, So that is why risk parameter will be 35. Risk weight will be 35. But when you allow LTV more than 80 means what? You are giving loan on the value of the house. More than 80 mean your margin is reduced. Okay, margin is reduced, so risk is more. Margin is reduced, you are dispersing more loan, no? You are dispersing more loan. LTV more mean, more than 80 mean you are dispersing more loan, then risk is, then you are taking a risk. Okay, so risk weight should be more. So risk weight will be 50%. Understood, madam? Logically, you have to, yes. Now, LTV stipulated will be higher when the risk under the loan is lower. The answer is B.
Sir, then here also if LTV ratio is higher, then risk is higher only, no, sir?
No, madam.
Risk should be higher, no, sir.
No. LTV is stipulated higher mean you are dispersing more loan, boss. You are dispersing more loan. Okay. When you disperse more loan, when you will disperse more loan, that means your margin you are reducing. Margin you are reducing. When the risk under the loan is less. Okay. So you analytically apply, that is the correct answer. Okay, friends, convinced. Okay. Because ultimate search score in 1 year they had asked 5 questions.
Bankruptcy.
Yes.
Bankruptcy.
Yes. It is to determine pre-assess bankruptcy, likelihood of bankruptcy in the next 2 years. He advocated a formula, very famous formula. Okay, 5 parameters will be decided. Okay, so it is, the actual answer is B. Any corporate, whether it may go to bankruptcy, okay, and that will be decided like a scan, scan. So that test is called Altman Z score. The score should be high, mean the company is financially stable. The company is very low, mean the score is low, mean so it may of bankruptcy is high when the Z score is
Below below 1.8.
B1B.
Below 1.81. Below 1.81, not between this, is a dead low. Okay, then it will become a issue. The bank, the particular company, in all probability, may become a insolvent company. What is the difference between insolvency and bankruptcy? That will not be a question in the exam, but that will be a question in the interviews. Insolvency will be decided by, even bankers can decide, but bankruptcy will be always decided in a court, appropriate court. Both are same, but we cannot declare a company as bankrupt. Only appropriate court can decide. We can only declare him insolvent. Okay, or he himself can declare as insolvent. Self-declaration also is possible. Some people will tell, sir, I am insolvent. So I may be declared as a bankrupt. But court will decide. Okay.
Solvency is declared by whom, sir?
Solvency is different. Solvency is decided by an auditor or a banker himself. Insolvency is decided by the auditors or a banker or any qualified person. By looking at the balance sheet, you can tell what this company is getting towards insolvency. But bankruptcy ultimately will be decided by the appropriate court. That's the only.
Sir, is there is any chance to come the problem in this ultimate set score?
Yes, no problem. Actually, that year itself, so many protests they were made because the ultimate set score is not at all applied in the banking system, madam. It's only a concept. Okay, banks are not applying this. So 1 year by mistake, 5 more questions they had given. Afterwards, they have not asked so far. 1 year suddenly, 5 more question. And the score is based on these 5 parameters. That 5 parameters is remembered. The 5 parameters is remember. One is profitability. Okay, if the profit is coming down, the company may go towards bankruptcy. Okay, one parameter understood. If bankruptcy may be triggered, if the profitability coming down, they are always into loss. Number one, liquidity. they are unable to pay to any creditor. They are unable to pay to any creditor. So that is liquidity. So liquidity. Solvency. Solvency means they are taking loan, but they are not capable of repaying the installment and interest. So there is a breakdown. They are not able to meet liquidity. They are not able to pay to the lenders. And leverage. Leverage means high loan they are taking. Leverage means not down. So much loan they are over debt. Okay, I think one of you please mute it. When you want a question, you please unmute. Please mute because the black noise becomes more. Okay, yes. Leverage. Leverage means taking left and right loans, over loans. Then activity ratio. Turnover will be the turnover ratios. Okay, high level of inventory, high level of book debts. Okay, high level of yes loans. So all these negative features, okay, debt equity ratio, all this ultimately will kill the unit. So the ultimate set score is based on 5 parameters that you remember. Formula is very
Sir,
complicated, don't worry.
sir, one doubt. What is this base point value, sir?
Huh?
Base point value. Basis point value.
Yes. Basis point, so that is in treasury. That is any change in the bond per 1 point change. What will be the change in the bond? I think treasury that is called as BPV, basis point value. Supposing a bond changes by value 1,000 rupees. Yesterday it was yes, the change in the price is 1,000 because of 10 point change in the interest rate. 10 point change, 10 point mean 0.10. 40 points mean 40.40. So what is basis point value? 1 point change causes how much change in the value of the bond. That is called point value. So here the answer is simply divided by the point. I think that they will have given in the maybe in the treasury. It's a treasury subject. Okay. Yes. Okay, friends. So 84 Basel 3 ultimate set score is a risk. We all are interrelated. Don't worry. All the four subjects: international banking, risk management, treasury management, balance sheet management, all are four into 25, 100 marks, 100 questions they will ask, 120 minutes you have to answer. Now 85, a forward contract. A forward contract will manage what risk, and it can be up to what, how many years it will manage. Exposure up to how many years it will manage. The answer is whether interest rate risk, no. Forward contract is not meant for interest rate risk, no 3 year. Okay, liquidity risk, no, it is not meant for liquidity risk. Exchange rate is 1 year. So answer is C. Answer is C. I think all of you are aware of the forward contract. Forward contract is again a hedging product. Is one of the very important derivative product that will manage only interest rate. Sorry, that will manage only exchange rate risk. And again, up to a tenure 1 year only. Up to a tenure 1 year from today. Okay, that is a beauty of forward contract. Okay, the opposite is yes, currency option contract. That is also will manage currency option. They are calling currency option will manage what risk for exposure up to how many years. This will also manage up to 1 year. So the currency option also will manage exchange rate risk, not interest rate risk. That will manage yes exchange rate risk for exposure, because risk you have to be managed. Any risk you have to manage by using a tool. What is the tool you will use? Any corporate also, now mostly corporates are using. And what banks are doing? Banks are selling the product. By selling the product, banks are earning a lot of non-interest income. Okay, but the risk for the customer becomes a business for the bank. Is a risk for the customer, corporate customer, and it is a business for the banker. Okay, so this risk can be easily managed by entering into a forward contract or option contract. Forward contract can be for any amount, but the option contract normally will be for very high, huge amounts only, 250,000, 500,000. Okay, like that. Okay, so the answer is liquid risk one, and not liquidity risk. Exchange risk, again, C is the answer. Okay, C is the answer. Now, question number 87. One small question: how to calculate the capital, risk and the investments, assets. Now you see question number. There are 4 banks. I think this can be a 5-mark question also. Earlier days they used to give. Now different question they will give. Bank A, all the bank has got 1,000 crores only. This bank also 1,000 crores. This bank also 1,000 crores. 200 crore, 500 crore, 300 crore. Now they will ask the question, which bank is better? Which bank is the, yes, safe bank, safest bank. So here, for example, capital needed for bank A. What is it? Capital needed low mean is a good bank. Capital needed high mean high risk. So that is how you have to judge the performance of the bank. You see, bank A, 500 crores assets in 20% risk category. They have given some corporate loan, 500 crore. All the corporates are 20% risk category. So here 20% 500 crores they have given. Another 300 crores assets they are given to 50% risk category. 50% mean A category, rated A. Okay. Some 200 crore they have given. So the total 1,000 crore and the 200 crore 100% risk category. Now the question is, what is the capital needed for a bank? The capital needed for a bank, you have to find out risk weight. How to find out the risk weight? 500 into 20%. For every bank, you can calculate like that. Only one example I will tell you. Yes, the question is, for bank A will calculate. This they may give for 3 banks also, 5-mark question also. But a sample is a simple question. You will know how simple it is. Okay, bank A 500 crores in 20%. No, what the risk weight? 500 into 20%. So risk weight will be 100. How you got 100? Just 500 in the risk weight. So 500, 20% means 100. Next, 300 crore they have invested in 50%. The 300 crore loan they have given to the 50% risk at company. So 300 into 50% means 150. 150 crore is the risk weight. So the exposure into risk weight you calculate. So that will be risk weight is 150. The third category, 200 crore, but 100% risk. So the 200 crore, 100% means entire 200. Because 100 is not risky, no? So 200. So the total risk weight will be 100, 150, 250, 450. So if they have to meet a capital of 9 only for this portfolio. Okay, so 40.5. Similar way, you can calculate for bank B. You can calculate for bank C. You are not giving same way you have to calculate. For example, bank C, how to calculate 200 crore into 200, risk weight is 200. Plus 500 into 50 is 250. Plus 250, risk weight is 250. This is 300 crore they have invested. They have given loan, not invested, maybe investment or loan. Okay, that is 20% risk category. So 300 to 20, 60. So 60 plus 250 plus 200 like that. So for every bank you have to calculate. Okay, it may be a 5-mark question. Just to give an idea. Understood or not? How to calculate for each bank. Then the question will be, which bank has the lowest capital charge? Which bank has the highest capital charge? Which one, boss?
Bank B.
Bank B, correct. Easily you can calculate. Okay, I am not giving the other thing because it is a very simple way you can calculate. But sometimes simple questions also they may ask, so you should be ready because the questions will be on rotation basis. Your luck is there. Some simple question also will come. So you have to calculate for bank B, bank C. Then they will ask some 2 questions. Which bank is the safest? Which bank carries more risk? Risk weight for which bank is more? Capital needed for which bank is more? So all these questions they will ask. So you can easily answer. Okay. So this bank needs 40.5 crores capital under bank.
That is 40.5, no? 45, sir. 45, I think.
No, 450 into 9, how much, boss? 450 into 9. Take your calculator. Okay.
40.5, sir.
40.5. Correct.
Correct only, sir.
Yes. 500 into 9 only 45, boss. This is 450 only, no?
Risk weight or capital answer is same, sir.
Yes. Risk weight 200 is 200. This is 350, 350. Similar way you can calculate. For bank B, no? This is 200.
36.
This is 100.
36.
Sir, with
yes.
what is the
This
conclusion, sir? Lowest capital is a good bank, sir.
45.9, sir.
Yes. Whichever
So, yeah.
requiring lowest capital, that bank is the safest bank or strongest bank. And
So
whichever
here
bank
we have
needing
arrived at
more
RW.
capital means,
So capital is that
yes.
only.
Yes. Agreed. Very good. You are all updated. Anybody having a doubt, please tell. Okay. Now 88. 88. Okay. The question is, what is the capital charge in the following situation? Is it indirectly they are giving? They will not give directly, indirectly. To answer the question, you should have the background information. Bharat Bank, they have got 2,000 crores NPA. Are you still remembering? Okay, the answer has come. Don't worry. Bharat Bank is not animated. 2,000 crores NPA, where the provisions available for the 2,000 crore is 1,100. They will not give any percentage. There they used to give, earlier we discussed, they gave percentage. Now they will only give, but to do this sum, you should have the full information. So the provision available becomes 55%. The provision available becomes 55%. When it is 55%, the risk weight assigned will be 50% only. The risk weight assigned will be 50% only. You remember the rule. I will give the chart at the end. Okay. So if the provision available in a NPA is 50 and above, the risk weight assigned will be 20%. Okay. So 2020%, sorry, 2050% mean 1,000, 9% mean 90 crore is the capital needed. Okay. Indirectly they are giving. So to answer this, you should have the, yes, ready-made. You should remember the rule. Okay, friends? Okay. That is 88. Now 89, what is the provision coverage ratio in this example? Simple, PCR. Sometimes they will call PCR. PCR means provision coverage ratio. 2,000 is the exposure NPA. 1,100 is the provisions available. So 1,100 divided by 2,000 into 100, 55% is the provision coverage ratio. The 55% is the provision coverage ratio. Okay, but banks are needed to build up 70%. The provision coverage ratio arises only in NPA accounts. Okay, not in standard accounts. Standard account there is no compulsion, but in provision accounts, okay, sorry, in NPA account, how much provisions you are having versus the NPA, what is the percentage? 55. But RBI wants overall NPA provision coverage should be 70 and above. 70 and above, but for some banks it cannot happen immediately. They have to build over. Okay, the advocated PCR is 70. Okay, that is 89. 90, yes, you see the question. Basel 3 implement, I think this also will be repeated in, yes, balance sheet. Basel 3 has prescribed CET, common equity tier.
D.
One is,
D.
yes, how much?
Sir, can't we give above more than 50%, sir?
Which one, madam?
Previous question, sir. Provisions available is 1,100.
Yes.
We shouldn't give more than 50.
Yes. The provision is available more than 50. So the risk weight will be just 50%. That is why 50%. 2,000, 50% is 1,000.
Yes.
On 1,000, 9% is 90. Capital needed is 90 crore. Risk weight is 1,000 crore. Because 50. So indirectly they will give. But to do that, you have to remember. Okay. 50 and above mean 50% risk weight. 20 to 50, okay, 100%. Less than 20, 150%. There are 3 grading in NPS. Okay, 3 grading in NPS for the purpose of risk weight. For the purpose of risk weight. Okay, friends? I think we have done. Now 80, question number 80. Basel 3, yes, 5.5. CET, okay, this is a balance sheet question, but risk to manage the risk, okay, the Basel 3. Okay, Basel 3 is take care of balance sheet management, treasury management, everything is coming that. So here, the prescribed CET should be what percentage of total RWA? Total RWA means credit risk, operational risk, market risk. On that, what should be the, yes, that is minimum to be achieved by the banker. Okay, now additional tier 1. The CET mean apart from additional tier 1, 81, they call it 81. The CET should be 5.5. Additional tier 1 should be 1.5. So it will become 7. Tier 2 will be 2, 9. Then CCP will be minimum 2.5. So 11.5 is the minimum capital all banks are expected to achieve, yes, as on 31/3/2019. Okay. So, okay, now 90 over. 91. Basel 3 has prescribed Tier 1 capital as dash percentage of total RWA. What is the risk-weighted asset? Tier 1 capital should be how much? How much, friends? Yes, 7. Tier 2, 2. CCP 2. So 2.5. Okay. So it's yes, this again. Now one more question. 92. Loan to Mr. A. Okay, rupees 8 lakh. A is the borrower. You have given a loan of 8 lakh. Secured by NSC 1 lakh. LIC policy with surrender value. Here sometimes they will give the remaining maturity and all. That normally they don't give because it's a complicated formula. So NSC 1 lakh and this LIC policy, yes, surrender value 20,000. What is the risk-weighted assets? Oh my God! I think here this part I think it is moving. What is the risk-weighted assets after affecting the applicable haircut? They may give openly. Now, first we will go to the answer. The answers are given. First we will pick up the answer. So the RW applicable is a first one retail. This is has to be background information. The risk weight what will be applicable. Besides a loan to an individual. So it comes under retail. Okay, retail up to 7.5 crore is a retail regulatory exposure. So the risk weight will be 75%. The risk weight will be 75%. That you keep it the yes background. Okay, now first before applying the risk weight, you have to adjust the collateral because the collateral always you can sell your share of realization, no, and it will be subject to haircut also. So second is okay, yes, deduct eligible securities, eligible collateral security approved by Basel III. So here the NSE is completely approved, and in NSE zero haircut, zero haircut. And for LIC policy surrender value 20,000. He has already pledged that LIC, assigned that LIC policy, pledged that NSE. So it is already available with us, with the bank. Bank can always get the cash. Okay. So 1.20 lakhs, here zero haircut. So first the 8 lakh minus that 1.20. Before applying risk weight, first adjust the collateral. So the collateral when you adjust, it becomes what? 6.80. Because 8 is the loan given, 1.20 anyhow becomes a cash security. So you minus it becomes 6.80. And the applicable risk weight is 75. So 75% of 680 is 510. Click the answer 510. D is the answer.
Sir, actually the question is risk weighted asset. Then capital ketadana sir into idu pannom.
Yes, they have put only risk weighted. The question is risk weighted assets. Now capital, if they ask again, 5.10 is the risk weight only. Now capital
Again
means
9%. Okay, sir.
again 9%. That will come in thousands only. That will come in thousands only. Now it's a small loan, no? So small loan, now only risk weight. This is the 4th step. I think only 3 steps you can do it. First step, second
Okay,
step,
sir. Thank you.
but 1 mark within 30 seconds. Some question you need more time. I will tell you how. Okay, that is 92. Now 93, again arithmetic. You see now they are giving a small twister. Just to know, have you understood the LTV concept? A borrower availed housing loan, 85 lakhs for a flat. 85 lakhs for a flat. The basic cost of the flat is 80 lakhs. And the stamp duty, registration expenses 20 lakh. How much capital needed for this loan? Indirectly they are giving. You see, what's the cost of the flat? The registration, 8 is the cost of the flat. Registration, so total cost is 100. Okay, but now the bank has decided to give 85 lakhs. So that means the LTV is 85%. Loan to value is 85%. Understood how to calculate LTV? First, to find out the value of the house, including permissible item. and the loan sanctioned is 85 mean, it means 85% of the project we have funded. That mean it is more than, LTV is more than 80 mean, so the risk weight assigned will be 50%. It is a LTV is not more than 80 mean 35%. Only two slabs are there. So the 85 lakh is the loan we have given into.
I did not understand what this
Madam, here the question is just to cross check your, yes, one simple thing you have to understand. Yes, LTV
Sir, what is
madam.
admissible cost also, sir?
Admissible, yes. Admissible cost is registration and stamp duty is now loaded. Even in a car loan, the road tax and register office expenses are also added. So similar way, when it comes to the question of arriving at the value of a flat, that is why they are giving a indirect data. Basic cost of the flat 80, the stamp duty and registration 20. So the 100 lakhs is the cost of the flat, and you have sanctioned, the borrower availed 85 mean the LTV is 85%. Whether understood, madam? Yes or no? The loan to value. LTV stands for loan to value. Value mean value of the house, value of the flat. So
But LTV is the amount which is equal to loan.
Yes. The loan, LTV is nothing but how much loan you are giving versus the cost of the house. The cost of the house, including registration and all, 100 lakhs. Bank has given 85 lakhs mean LTV is in this example, 85% they have given the loan. So in other words, margin is only 15%. So bank has got only margin 15%. Bank has dispersed 85%. So risk is more. You have given up to 85% your loan, given loan.
Sir, we are calculating with the help of 85 itself now, sir. Then why we are calculating that 100 lakhs, sir? But by 85 itself, we can directly go for risk weightage 50% and we can able to calculate that capital.
No, madam. The 85% is what percent LTV is the decider, na, madam. The 85, how we have to LTV, the risk weight is based on LTV, madam, now. The risk weight is based on loan to value. Okay. Now there
If
are
there
only
is
two
no
slabs.
stamp duty given, then we can go ahead.
If there is no stamp duty given, no bank will give 80. The cost of the flat is 80. How they can give 85 lakhs, madam? There is no margin. That is, yes, they have not. The cost of the flat itself is 80. How they can give 85 lakhs? So that means they have included. Yeah, they have included 20 lakhs also as the cost of the project. So 80 plus 20 they have loaded. Then only they have given 85 mean the LTV is 85. Unless we know the 85, we cannot apply the risk weight because the risk weight is dependent on LTV. Agreed, madam? So the LTV 85 mean risk weight is 50%. If the LTV is less than 80 mean risk weight will be 35%. So 85 into 50, 42.50 is the risk weight. Though the loan is 85, because of 50% is 42.5. Suppose they want capital also, just 9%. This is a risk weight, this is capital needed. Understood or not? This is a typical question they will ask.
Is 9% same, sir, for every case? Capital.
Yes. Every case they will give. Now mostly CIB, they will not give directly. They will always give indirectly. Okay. Here I can very well tell the LTV is 85%. No. If I tell 85% LTV, then it becomes a direct question. Now CIB, almost all the questions will be indirect. How they will make you think. The questions will make you think for a while and apply our norms. Then only, unless you have a full knowledge, idea, some questions you may miss. Okay. But attempt all the questions. Don't worry. No negative mark as of now. Attempt all the questions. So this question understood or not, boss? That is 93. Okay. Now we are going to. Yes, boss.
Kindly provide the chart for LTV to risk.
And chart is there, boss. 1 second. LTV, there is no, okay. The housing loan chart is there. If you want, I can just now tell. Okay. 1 second. I have shown that. I
Sir,
think
what is risk
Please
value
show the risk
for
weight.
when LTV is less than 80%?
when the LTV is less than not exceeding 80, risk weight is 35. 35.
35.
Sir, please
35.
the chart for risk weighted no.
Okay. You want the chart? Okay. I will want a chart. Okay. Okay. Chart I will show first. 93. Okay. Yes, this is a chart. Chart risk weight. There are, I think I have given 23 items. For example, loan guaranteed by central government, 0 risk weight. Loan guaranteed by state government, 20% risk. AAA rated exposure, 20%. AAA, you remember, by heart you will make it, madam. AA rated, 30%. AA rated, 30%. A rated, 50%. Okay. BB rated, 100%. BB rated, 100%. And BB and below rated, 150% risk weight, because a very poor rated, no. Unrated corporate, 100% chart. Earlier it was in WALD format. I converted to, yes. Okay. Yes. Now, unrated corporate, 100%. Housing loan, this is the thing you wanted. Housing loan, LTV, not more than 80%, 35% risk weight. The LTV more than 80%, 50% risk weight. LTV more than 80 mean 50%. Only 2 slabs now. Credit card disabled, 125. Remember, IPO finance, 125. What is IPO finance? The other name for IPO finance is sometimes they will use the word bridge loan. Okay, bridge loan. A company is going for IPO to manage temporarily. They want a bridge loan. So that bridge loan will be 125% risk weight. Okay. Finance NBFC, 125%. Venture fund exposure, 150%. Consumer credit, 100%. Staff loan, 20%. Mortgage, housing loan. Staff other loan, 70%. Retail loan, up to 7.5 crore, 75%. Now, yes. Now, retail regulatory exposure up to 7.5 crore, 75%. Retail regulatory, that is repeated. NPA, when the provision less than 20, 150%. Risk weight is 150. Because provision is less than 20. When the provision is more than 20 and less than 50, more than 20, less than 50, it is 100%. But 50 and above, 50% and above, 50%. Commercial real estate, 100%. Commercial real estate also, housing loans are there. Because in a commercial complex, if a commercial complex will be that side, and housing loans will be, houses will be in this side. So that particular, yes, 70% risk. And again, the corporate fund under standardized approach operation risk.
Retail regulatory exposure greater than 7.5 crore, anything is there, sir?
No. Retail mean normally, yes, then it becomes as applicable to the category of the borrower. Then you will not come under retail. Then as applicable, it may be a corporate borrower. Normally retail, normally don't exceed 7.5, exposure limit is there. Suppose it's a corporate, then corporate comes under a different risk weight. Agreed. So as far as small borrower, so retail means small borrowers, individuals, maybe partnership, maybe so one person, yes, other than companies, okay, trust, some, yes, all those, okay, normally partnership, proprietorship and individuals up to 7.5 crore, other than the specified category, other than the specified category, mean house loan is separate risk weight. So all these, they are coming under retail regulatory exposure up to 7.5 crore exposure from the banking system. Risk weight assigned is uniformly 75%. Okay, friends, I think all of you remember this also. There is a standardized approach for operation risk. The business segment, 8 segments are there. Corporate finance, whatever income you are earning, that is 18%. Okay, that is called as beta percent. Okay, I think please mute one of you. One of you please will remain in mute mode, please. Because, okay, understood, friends. So this I am sharing. And also I am sharing your CCF. Okay. Now we are in which question? Yes, we are in. Yes, we are in. Okay. Now we are coming to the climax. Don't worry. Even if you go, yes. Okay. This is the question 93. Now 94. 94. Now it's an important question, friend, because the portfolio manager. Similar question. The twister question they will always ask. A portfolio manager mean nothing but a treasury manager of the bank. He is having 1,000 crores funds. He is having surplus. That is investable funds are 1,000 crores. Okay. And what he does, he invests in all investments should not be in one basket. Don't put all the eggs in one basket. You have to diversify your investment to spread the risk. So what he is doing, 75% of this amount, 1,200, in 20% risk weighted instrument, carrying 8% coupon rate. This 8% is different. This 20% risk. Here coupon mean return. Coupon mean rate of interest. And the remaining 20% of the 1,200 crore is investing in 30% risk weighted instruments. That is B. Okay. There are two instruments is investing. And that instrument carries what? 10% coupon rate, but risk is 30. 10% coupon rate, risk is 30 mean the net return is 7%. You can easily remember. 10% coupon, but 30% risk mean 10 minus 30%, 7% is the return. So here 8% coupon, but 20% return mean 8 minus 1.6, 6.4 is the return. You understood? So always you have to of the risk also and the interest rate also. The income will be reduced by the risk. The income will be reduced. Yes, madam.
I didn't
Sir,
understand.
can you please report?
Please
repeat
repeat.
that?
This is very important. We are coming to the climax. Don't worry. Risk management, madam. One treasury manager. You assume you are the manager of your bank. The bank has told you to manage, invest 1,200 crore they have given to you. You manage it. It is your discretion. Now you are finding two instruments you have located finally after research. What is first instrument? 20% risk, but it is giving 80% return. Now immediately note down, though it is giving 20% risk, but is giving how much return? 8% coupon. Coupon means rate of interest. Every 100 rupees, it will give you 8 rupees. Every 100 rupees, if you invest, 8 rupees. But risk is 20. What does it mean? Whether you will get 8 rupees or something less. Tell me. Whether you will get something less or something more.
Less, sir.
Why
6
something less or more?
Something
Less.
You will get something less. Why? Because 20% is the risk. So many percentage should not confuse you. So that is why people are, you read the question, sir, what is this 75, sir? What is this 20, sir? What is this 8, sir? What is this? So many percentage, don't get confused. Aram se, you look at the question. You are having 1,200 crore. Now you have to invest. Now you have to invest in two instruments. What are the two instruments? One is 20% risk, but 8% return. Another is 30% risk, but return is 10%. Now the first question is, what is the total risk adjusted return? After adjusting, first how much is investing, we'll see. 1,200, no. Entire 1,200 is the total money. 75%, how much 75%? 900. 75% of 1,200 is first, how much is going to invest in instrument A, how much is going to invest in instrument B, we will find out. So 1,200 is the total fine. 75% of 1,200, 900 crores. Agreed? Okay. Next one is investing in B instruments. Is a highly risky, but return is more. You see, your risk is 30, but return is 10, Here return is 8, risk is 20. So like that. Now you have to adjust the return, adjust the risk, and you have to find out the risk adjusted return. So in 1,200, how is investing? 900 in A, 300 in B. This first part over, no? Okay. Now come to the second part. Return in first, 900 crore is investing, but he will not get 8 rupees. 8 minus 20%. 8 minus 20% how much? First you assume 72 crores you will get. 72 crores minus 20% is 57.60 only you will get. You can calculate per also, totally 900 also you can calculate. Per 100 rupees, how much is getting, boss? Just now you told 8 minus 20%, 6.4. 8 minus 6.4. So 900 into 6.4 you calculate. 900, take your calculator, 900 into 6.4, press your percentage button, how much you are getting? Are you getting 57.60? Yes, okay. So first A type instrument over. Now B, come to B. Now how much is investing in B? 300 crores. What is the risk weight? What is the income? First you take the income. 10% coupon. So 30 into 10%, 30 crores you will get the income per year. But risk will reduce your income. Minus 30% risk. 30 minus 30%, 30 may 30% 9. So 30 minus 9, 21 crore. So the total risk adjusted return is 57.60 plus 21, 78.60 crore is the answer. This you click 1 mark. How many of you understood? All of you have to
Yes, sir.
understand.
Understood. Understood.
There is no question of not understanding. You have to understand.
Understood, sir.
Yes. Okay.
Understood, sir.
Okay. Now next question is not risk as the return. They will ulta. You see the ulta. Now they are going to ask what is the risk weight in this investment. Okay. Oh, that question I have. Okay. I should have given that also. Okay. So risk adjusted return. Now can you calculate the risk weight on this? Risk weight means you don't worry about the rate of interest. Risk weight is easy. 900 crore in 20%. So 180 risk weight. 900 crore is invested in 20 mean 180. Risk weight, you don't look at the yield rate. Suppose in the same question, instead of what total risk weighted return, so the second question may be, what is the risk weighted assets? What is the risk weight assigned for this portfolio? Then what you have to do? 900 crore into 20%, 180. The
Total 270.
the 300 crore carries what? 30%, that is 90. Very good. So 180 plus 90, 270 crore is the risk weight. Okay, capital needed also they will ask. Then 9%.
Capital into
So
9%.
this is the typical question they are asking. Agreed? Very good.
Sir,
95.
one thing I want to ask.
Ah.
When the question came, you are minusing 10% coupon with risk weighted. Why we
Yes.
were doing this?
Madam, the risk will reduce your income, madam. Madam, 30% means what? Is a probable loss. First itself, we have to recognize the loss. 30% of income you may lose. So right now you recognize, don't recognize 10%. 10% minus 30%, that is 3. 10% means 30% is 3. So actual effective return is 7% only. Why 7%? Now 300 into 7 to 10. 300 into 7, 21 crore. You can get like that also. 300 you are investing. Your return is not 10%, madam. You have to adjust the risk, The risk when you adjust, it becomes only 7%. So 300 into 7 is 21 crores. Agreed? So here...
Sir, 30 minus 30 percentage risk means 30% of which one, sir?
30% of 30, boss.
Only 30%.
30% means, suppose in TDS 10%, boss. Boss, I will give a simple question. Yes, I will give a simple question. You are getting 9% rate of interest, boss. You are investing as a staff, you are getting 9%. TDS is 10%. Now tell me, what is your return? What is your net return? You are getting 9%, friends. Is a question to all of you. Please remember, you are getting 9% return on your deposit.
8.1.
But TDS is 10%. Then what exactly you are getting? 9 minus 10%. 10% of 9 only. 10% of 9 is 0.9. So 9 minus 0.9, 8.1. Very good. Understood or not? Same logic you have to remember. Okay. Agreed, friends? Yes, very good. Now 95. Okay. The same way we have already done. But anyhow, Are you still remembering one test? Bank A opened a documentary LC, 10 crore. Suddenly they will ask one question like this. Bank opened a documentary LC 10 crore backed by collateral security for a AAA rated corporate. What the risk weight? What's the capital charge? Similar question you have done. Okay. Now, first one, you have to apply the documentary LC. First, you have to apply CCF. What is the CCF? Entire 10 crore may not become a credit exposure. So 10 into 20%.
20%.
Is LC 20. So the 10 crore will become what? Credit exposure will be 2 crore only. Credit exposure will be 2 crore. Agreed. Again, the category of the borrower, AAA. So risk weight assigned for AAA, anybody?
20%, sir.
20. So the 2 crore again 20%. 2 crore again 20% means 40 lakhs. Okay, risk weighted assets is risk weight is 40 lakhs. Then what is the capital needed? 40 lakhs into 9%, 3.6 lakhs.
3.6.
Understood? So this is how they will ask. Simple question only they will ask.
Hello.
The credit conversion factor I am giving right now. Collateral LC we have discussed, but anyhow for you to easily remember, collateralized LC 20%. CCF is not risk weight. CCF.
Sir, last question.
Performance guarantee 50. Performance guarantee 50. Financial guarantee 100. All other standby LC also 100. CCOD likely to withdraw in the current year 20. Term loan dispersal during the current year 20. Next
Sir?
year 50. Yes, madam.
So in the last question, where they have asked about standardized approach.
Which one, madam?
So in the last
Standardized.
question.
Madam, here they will not ask standardized approach. They will only tell when this data is given, AAA rated, this 10 collateral, then it indirectly you have to, that is why indirectly they will tell you have to apply no standardized approach. This is not a, now advanced approach, normally questions will not be there. Standardized approach, questions will be there. Standardized approach means for this particular standard LC mean standard 20% CCF, and is a AAA rated mean risk weight is 20%. So that is why some people get confused. Sir, what is the 20? What is this 20? Okay, so in the name of percentage, they will try to mislead you. Okay, understood, madam? So you have to apply necessarily when the question is like this, you have to find out risk weight using standardized approach only. No other approach possible. The data given is
40 lakhs.
which one, madam? Which one, friend?
Sir, RWA 40 lakhs need to come.
RWA 40. Okay. Now capital charge mean on that 9%. Okay, understood? Yes. Okay, boss. Now we are coming to the crucial RWR guarantee. For example, I am giving. One bank issued a performance guarantee 10 crores to a corporate customer was not rated. Was not rated. What is the capital charge?
100%.
Needed for exposure. First apply CCF. 10 crore becomes CCF when you apply 50% is the performance guarantee. It becomes 5 crore. Credit exposure will be 5 crore. But risk weight is a unrated borrower 100. So 5 crore, 5 crore. The RW also 5 crore. Risk weight also 5 crore. Now capital needed will be 5 crore into 9 by 100. 45 lakhs is in this example. Click 45, 1 mark. Okay. Yes.
Sir, can you explain again, sir?
Madam, one bank has given a performance guarantee. How much they have given? 10 crore. Performance guarantee is not a funded liability. It is not a. We are not given any loan at this time. We are not given any loan, madam. We have given only a commitment. Please remember, we are not. Our funds have not gone out. Bank has not given any dispersed any funds. Now funds are still with the bank. So it is called as non-funded exposure. And again, the nature of the guarantee is performance guarantee. The CCF applicable for performance guarantee, bid bond guarantee is 50%. CCF means what? The 50% of the guarantee may become a liability for the banker. Now, right now, there is no liability. When you are issuing a guarantee, there is no liability. It's only a secondary liability. Secondary liability means it may happen or may not happen. So you are issuing a guarantee. But Basel 3 tells even for non-funded exposures, you have to calculate risk weight. For that also, you should have adequate capital to absorb any future loss. Agreed, madam? So the performance guarantee attracts CCF. CCF means credit conversion factor 50. First 10 crore, 50% means 5 crore. Okay. 10 crore, the credit exposure when you CCF you apply 5 crore. Okay. Because 50%. So 5 crore. But risk weight is unrated borrower. Is not a rated corporate. It's a corporate. So the risk weight is 100%. So 5 crore, 5 crore. So what is the capital needed? 500 crore. This is actually 500 lakhs or 5 into 9%, 0.45 lakhs, 0.45 crore. In other words, 45 lakhs. You see the answer. If they are given in crore, you click 0.45 crore. If it is given in lakhs, you click 45 lakhs. You get the correct answer. Understood or not? Yes, friends. All of your, yes, all the people who have logged in, yes, these are the concepts. Have a quick reading, but not reading, you have to assimilate. That will help you to do, yes, wonderful score also, your score rate also. People are, yes, understood the logic behind all numerical problem. They are getting 70, 75 marks. They are easily getting. Okay, international banking, treasury. Okay, so 97. Risk management through derivatives. Risk management through derivative. Here one small, this they will give a situation. Case study they will give, a situation they will give. A bank is having floating rate housing loan, 1,000 crores. Rupees not 1,000, okay, 1,000 crores. Okay. 1,000, okay, let it be 1,000. No housing loan can be for 1,000. Funded by deposit. How they are giving the 1,000? Where the money comes from? Deposit. But what is the cost of the deposit? 8.4. Average they because the fixed cost, the deposits they have got at fixed cost, that deposit they have used for giving a long term housing loan, and the housing loan 1,000 crores. Okay, the average cost of the fund is 8.4. Now the floating rate comes down. Floating rate last week repo rates are reduced mean keeps coming down. Now when the rates are coming down, but your cost of deposit is already fixed at 8.4, the bank is facing a risk. What risk they are facing? Interest rate mismatch risk they are facing. Why there is a interest rate mismatch? Because the deposits are at fixed rate, the loans are at floating rate. The problem is both are not matching, because now the floating rate comes down, then you have to charge lesser rate, then it becomes a loss. To prevent the loss, you have to do a derivative transaction. The derivative transaction nothing but managing risk. Yeah, every risk can be managed. Every risk is there. Risk means financial risk, financial loss. Always you have to be proactive towards prevention of, yes, prevention of what? Loss. So that hedging tool is called as interest rate swap. How they will do, don't they will not ask. But what is the product used by the bank to manage this interest rate mismatch risk? You immediately reply IRS. Agreed, friends? Okay. How the IRS works and all, it's a very big chapter. Don't worry. Okay, that is normally done in classrooms. Now a beautiful question. Climax.
This
Climax.
interest rate risk, mismatch risk, gap risk, all these are like similar. How to differentiate, sir?
No, madam. Interest rate risk is mismatch risk is different. Gap risk is different. Gap risk, normally in Forex also gap risk will arise. You are overbought, oversold. Okay, I think we'll have discussed. But in assets also it will, balance sheet management also it will arise. Just wait, madam, tomorrow. Tomorrow we are thoroughly analyzing the balance sheet management of banks, not balance sheet management of corporates. We are managing our own balance sheet. Bank's balance sheet you have to manage. Okay. So now another question. Yes. A bank invests 1,000 crores. Very good. Now it's similar to the one we already discussed. 6% government security. 6% mean the rate of return. They will only give 6%. Sir, what is this 6%? Don't ask, because this is 6% is the return on these securities. Zero risk, boss. Government security, zero risk. 600 crore they are putting in this. Okay. The remaining 250 crores they are putting in AAA rated security, but that gives return 8%. And the AAA risk is 20. And how much they are investing? 250. Now the third one is the now how much is remaining? 1,000 crore, 600 invested in government securities, 250 invested in AAA securities, 150 invested in A securities. So over. Now all 1,000 invested. Now the question is, what is the risk adjusted return? After adjusting the risk, okay, what is the return? Okay, now how to do it? One by one you can do. Very simple. Next question is 2 questions. What is the risk weight for this exposure? Because you invested 1,000 crores, 1,000 crore, it carries a risk. First return, how much you are getting. So the first 98 will take it. First 98 return. The first one, okay, friends, zero risk. So the entire 36, 600 into 6, 36 crore you can recognize. Yes or no? Understood the first step or not? I think one of you, please, and the black noise comes. Remain in mute when you want to ask and unmute. You understood first is a zero risk, 600 crore. So how much income you will get? 600 into 6, 36. Full you will get. No minus. Why no minus? Why no minus, boss?
0% risk. Government
0% risk.
Second you note down. Second you note down. 250 crore you are investing. 250, but is a 8%. But risk is 20. Now whether you'll get 8% or something less? Tell me.
Less, sir.
8% or something.
6.4.
Less, sir.
6.4.
6.4.
So 250 into 6.4 you calculate. 250 into 6.4 you all of you calculate. 250 into 6.4. Okay, minus 8. You'll get what?
16.
250. Yeah, how much you are getting?
16.
16. 16. So 36 on government security. 16 crore income on assured income. That is after adjusting the risk. After adjusting the risk, 16 crore. Now the third is 150 crore you are investing in, yes, 10% security, but risk is 50%. Though you may get 10, the return is, effective return is 5. So 150 into 5, 7.5 crores only will get after adjusting the return or risk. So the total return will be 59.5. Then they will ask, what is the effective return? What is the effective return? You are investing 1,000 crore and you are getting 59.5. So your effective return, your overall return or average return, anywhere they will use, is 5.95 only. Though you are investing 6% here, 8% here, 10% here, but your average overall income become 5.95. Understood or not? This is first point. Okay. Risk weighted adjusted. Okay, now second one. Now you don't. Now
it becomes 5.95, sir.
5.5 boss. 59 divided by 1,000. 1,000 you are total invested. All put together is the total income, boss. Is the total income.
Okay.
Total investment is 1,000. So 59 point divided by 1,000. Just a percentage button you put 5.95. One digit to adjust. So the overall return is 5.95. Agreed? Okay. Next one, 99. Now, next one is what is the risk weight for this exposure? Now, risk weight, don't look at the return. The 6, 8, 10 you completely forget. Now, while you are calculating risk weight, don't look at the return. Now, you simply tell 600 crore into zero risk. So, it is 0. Because 0 risk, 600 into 0, always 0. So 0. Yes. Risk weight is 0. Now 250 crore you are investing. Don't look at here. Don't look at this here. When you are calculating risk weight, don't look at the return. So 250 crore you are investing 20% risk. So 250 into 20%, 50 crore is the risk. Next one, 150 crore you are investing, but at 50% risk category. So the risk weight will be 150 into 50%, 75. So the total risk weight will be 125 crore. Here it is zero because all you have invested in government security. So zero risk. So the risk weight is 0, 50, 75, 125. Now how much capital needed? Capital needed will be based on risk weight. Capital needed will be based on risk weight. So 125 crore into 9%, you'll get 11.25 crore. Understood or not?
Yes, sir.
Okay, friends, understood or not? This is the question.
Sir, but here they have given like AAA rated and A rated, huh? So no need to.
No. They are already giving risk mean, you don't worry. What they are given, that you got. The
They are
risk
not
already they are
giving
given.
any risk, we have to consider.
Okay. Yes. They will always give like this. 20%,
Sir, in this,
50%. Here they
sir,
may
in
not
this
tell
case,
A rated. Sometimes they may not tell A rated. Simply they will tell 10% debt instrument, 10% security, 50% risk. That's all they will tell. The rating and all, sometimes they may tell, may not tell. Okay. So you are, why you worry? Because they have put 10%, 50, that is sufficient for you to do the calculation. Agreed or not? You understood the steps? Yes.
sir,
Return
one
mean,
doubt, sir. Actually, yes, sir. In this question, in case the risk weight for this exposure is not given, but asking the capital needed only means, how do we calculate this, sir?
No,
9%.
unless, okay. Your question is very good. The risk weight, if they don't give capital mean, unless you calculate the risk weight, you cannot go to capital. Without this step, you cannot straight away go to capital. First, you have to calculate the risk weight, even if they don't ask. First, you calculate the risk weight, 125 crore. Then you apply 9%. Then you get the capital. Okay. So if they don't ask, you cannot come straight to capital. Necessarily, you have to calculate the risk weight. Then that is why capital is based on risk weight. Capital is based on what? Risk weight. Okay, friends? Understood?
Okay, sir. Thank you,
It's
sir.
a wonderful question. Okay. Now another beautiful question. One question they will necessarily ask in the downgrading rating migration chart. They will give a migration chart. What is migration chart? Please remember, it's a very important question, but people are missing. Very simple question, only they will ask, sir, what is this big chart, sir? How to understand this? No issue. Don't worry. I will explain in a simple way. They will give a big chart. It's a case study. Sometimes they will give 5 marks. Here I am going to give you 10 marks. Don't worry. Now you remember, first don't look at the question. Now remember, do the chart. There are 860 accounts in a bank. It may be a bank or in a branch. 860 account. So 100 account, there is just a data. 100 accounts last year, it was in AAA category. Sir, what is the AAA A plus? This is by, don't worry. Sir, you only told AA, sir, here AA plus, that you don't worry. They have already given AAA 100 accounts were there. AA plus 100 accounts are there. A 200 accounts are there last year. Triple B 400 accounts. C category means very poor category. Okay, almost near to NPA. 60 accounts are there. Now, as of now, no account in NPA. As of now, no account in NPA. 860 accounts are there, loan accounts, as at last year. Next year, all disaster. Next year, so much problem. Okay, understood. This is called as rating migration. Remember, rating risk migration. Migration means it will be downgrading. Some accounts will be upgraded, some accounts will be downgraded. What is downgrading? Moving down to the lower grade is called downgrading. Okay, moving up from one category to a better category is called as upgrading. In the next year, 70 accounts are still in AAA. That means another 30 accounts are totally destroyed. Destroyed means downgraded. 100 accounts are there, 70 accounts are still in AA. And 16 accounts have come down to AA plus. Please, I think one madam has to Please, madam, climax. Just ask the madam to mute. Okay. Because their background noise comes. Okay. These W accounts are 16. That is out of 100, 70 accounts still remain in triple A. That 16 account is downgraded to AA plus, and 4 accounts have moved down to AA. Another account, 3 account have still moved down, still moved on 5 account, still moved on 2 account. But no account has gone to default in NPA. But all accounts are distributed. Earlier 100 accounts were then AA. Next year is just a chart. Remember, just a chart to calculate. Have you understood the yes, rating matrix exercise? Believe it or not, 5 marks will be there. Now, next one you read. There are AA plus 100 accounts are there. Next year, what happened? You see, tsunami. Next year, what happened? You see, tsunami. Only 10 accounts remaining. Okay. Oh, sorry. 10 accounts have become AAA. So out of 100 accounts in AA, upgraded. 10 accounts are upgraded, but 60 accounts still in the same category. AA. So 10 accounts have been upgraded. Great. 10 accounts out of the 100 account last year, 60 accounts still in the same category. 10 accounts have become improvement, and 14 accounts slipped to one grade. Another 10 accounts slipped to another grade, and 2 accounts have become NPA. Oh, great. 2 accounts in this category have become NPA. Understood? This is only reading in the chart. Now you see the third one. 200 accounts were there last year. Just analysis of the data. And you can easily remember. 10 mark, 5 mark, easily you can score. I will tell you how. Okay. So now A category, 200 accounts are there. Okay. Now you see A category. Now how much are remaining in A category? 160. 20 accounts have been upgraded. All right, great. 20 accounts have been upgraded as A plus. The 5 accounts have become BB, lower. Oh my God. 15 accounts have become NPA. Out of 200 accounts, 15 accounts have become NPA in the next year. Then they will ask what is the percentage. This is the question they will ask. What percentage of A category account that have become NPA in the current year? Now, can you tell me what is the percentage? Simple. 215 mean what is the percentage, boss? One of you tell. Out of 200 accounts, 7.5. That's 7.5. Now you see the BB. That's why analysis of data. Analysis of data immediately is a simple question. They will ask. 400 accounts are in BB category, triple B category. Okay, and how many they are remaining? 240 accounts still remain. 20 accounts upgraded. 80 accounts C. Oh my God! 60 accounts have become NPA. 60 accounts have become NPA. Okay. So that means 15% is becoming NPA. That's all. Now, madam is very sharp, 15%. Now, last category, C category.
So how, sir? Can you explain, sir? Can you explain to calculate that percentage, sir?
Madam, 400 accounts are there last year. Correct, in this category. In this category, how many accounts are there? 400 accounts. This year, how many categories are still remaining in the same category? You see the look at the top. Here it is vertical, it is coming. Here it is 240 still remaining. So 60% of the account, 400 may 240, 60% of the account still remain in the same category. Okay, 20 accounts have been upgraded. What is the 20%? 20 accounts upgraded versus 400. 400 versus 20 mean 5% of the 5% have been upgraded. And how much have been slipped to NPA? Oh my God, 60 accounts have become NPA. The 60 account is what percentage of 400?
15.
60 divided by 400 into 100, 15%. Even without calculator, you can do. And how many accounts have become slipped to C? How many accounts have become slipped to C? Out of 400 accounts, 80 accounts have become C. Okay, so that means 20% of the accounts have been downgraded to C. Earlier 400 accounts are there. Now 80 accounts have become low graded, slipped to TC. So 80 into 400, that means 80 में 400 how much was? 20%, correct? 20%, 20%, 10% is 40, 20% 80. So the 20% of account, I think one line is the down because when I enlarge, okay, otherwise it will in the same line. So the 20% of the triple B category now have slipped to downgraded to C grade. This is the question they will ask. Now as immediately the C out of 60 account last year, 5 accounts have become NPA. Oh my God. Then what is the percentage? 5 divided by 60 multiplied by 100. Okay.
8.33.
Yes, 8.33. These are the question. Now we look at the question. Question number 1. Now question, look at the question. What is the percentage of accounts remaining in AAA category? Okay. What is the percentage account? 100 accounts are there. Easy. They will not. Here I have given 100. There they may give a different. Okay. But the steps involved are same. Don't worry. Here to easy to understand, I have given 100. So 100 accounts are there. Now how many accounts still remain in AA category? 70. So 70% remain in same category. Question number 1. Question number 2. Percentage of account that have become NPA in AA plus category. What is AA plus category? Earlier 100 accounts were there. Now that have become some accounts have become NPA. 2 accounts have become NPA. Then percentage wise 2%. Out of 100 account, 2 accounts have become default. Default means NPA. So 2% account NPA. Question number 2. Easily you can score 5. What's the percentage of C category account that become NPA? What is C category account? C category account that have become NPA. Oh, the C category account, 60 accounts are there. How much account have become NPA? 5 accounts have become NPA. So 5 divided by 60 multiplied by 100. So that will become 8.33. Just now we told you. Yes. Now, what percentage of BB category that doesn't change in the status? Same triple B, how many? 400 were there. Now still 240 are still there. In the same category, it continues. Others are migrated.
50%.
Some have migrated up, some have migrated down. So 60% is the answer. Now last question. Okay, 5 more I have given to you for practicing. Percentage of accounts in A category that get upgraded to A plus. A you see A. 200 accounts are there. How much was upgraded? 20. That means 10%. 20, 200, 10%. Now one more I have given. Easy to answer. What percentage of BB triple B account upgraded to A? Triple B account here now 400 upgraded to A. Upgrade to A means 20 accounts. I think this is okay. So 20 divided by 400 in the 5%. Now next question. Percentage of account that have become NPA in triple B category. Triple B category 400 account. Out of the 400 account, next year 60 accounts have become NPA. So that means 15% is NPA. Okay, 15. What percentage of A category account that have become NPA? Oh, A category also we have become NPA. Out of 200 account, yes, 15 account have become NPA. So 7.5%. Yes, yes. 7.5. Last one. 7.5. Next one. C category account that doesn't change in status. Same status. C 60 and here C 45. Okay. So 45 divided by 60, 75%. 75% of the C category account that doesn't undergo any change. Neither this way nor that way. That retain in the same category. Last question. Percentage of accounts in AAA category that downgraded to BB. That is downgraded to BB. Oh, A also downgraded to BB. How much? 2 accounts are downgraded to BB. Okay. So out of 100, 2 means 2%. How is it? Now tell me easy or difficult?
Easy only.
Easy, sir.
Easy,
Sir,
sir.
actually, sir, I have one doubt, sir.
Yes,
In case
yes.
percentage of accounts in AAA category, the downgraded, that's only mentioned means not to triple B, triple A, nothing mentioned, sir. Just how many account downgraded only means.
No. The bigger downgrading. Okay, you are correct. Okay, sometimes that is one downgrading mean it is now if it is in C category, next only one downgrading is possible. But in WA, there are downgrading in which scale you have to. They will tell specifically, madam. They will not. They will just downgrading. They will not use because there are several grades are there now, madam. So to identify which grade, normally when downgrading. Next, sometimes they will use the downgraded to next level. Supposing A mean WA mean next downgrading A plus, madam. They will use that word. Downgraded to the next lower category. That word you are correct. Sometimes they will use the word how many accounts or how many percentage of account, how much percentage account have downgraded to the next category. They will use the word. So simply they will not tell downgraded. Downgrade to the next category mean for WA account, A plus is the next lower grade. 2 grade mean
we have to take downgrade only.
Yes. No, downgraded to the necessarily they will use next. Simply they are using downgraded. Okay, you can assume next lower grade. Next lower grade. But it can be other lower grade also, yes. So A, below that there are 2 grades are there. Triple B is also there, C is also there, default is also there. So normally they will use the word downgraded to the next lower category or downgraded to so and so category. They will name it. Question you read carefully, accordingly you decide, you will get the mark. Okay, friends. Now probability of occurrence. And now we are coming to the final climax. Now measuring operation risk under a advanced approach. Now here there is a formula. That is operational risk is advanced approach, AMA approach. What is the AMA approach? Is the probability of operation. Here they will use a simple model only, but you have to remember the formula. What is the words they will use? Bombastic words they will use. If the probability of operational risk occurrence is, that is probability of occurrence. Probability of operational risk occurrence. That is the fraud may take place or may not take place. Probability means likelihood. Maybe 3 times, 3, just 3 they will tell. No percentage, 3. You see the question. Okay, it's a simple question, but you can do. But provided you remember the formula. This is called probability of occurrence, PO. The abbreviation is PO. Next, they will give the potential financial impact. The potential, because of any fraud, bank's image or financially, bank will be impacted. Okay, because not changing, fund transfer, so many. So the potential of financial impact is 6. Potential of financial impact is 6. Okay, that is called PFI. Okay, the formula only you remember, madam. Then you can do it. They will give the data like this only. Estimated impact on internal control. That is called IIC. That is called IIC. Impact on internal control. Impact on IIC. That is 1 minus, this is 1. So the formula is how to measure the loss, risk mean loss. In operation risk, OPR mean operation risk is square root. Now you have to put square root. The square root of PO, probability of occurrence 3, into the potential of financial impact, PFI 6. So 3 into 6, 18, into 1 minus 50%. 1 minus 50%, the 50% you have to convert to decimal. 1 minus 0.50. 1 minus 0.50 mean half. So here it is 3. 3 into 6, 18. 18 into half, 9. Square root of 9 is 3. Very easy. Only thing you have to remember the formula. Formula they will not give. Formula they will not give. Okay, remember, formula they will not give. The square root of 3 into 6 into half. How I got half? 1 minus 50%. 1 minus 50% means 0.50. Again point. So the 3 into 6, 18. 18 into half, 9. Square root of 9 is 3. So this means rating matrix they will give. This you have to remember. So the rating matrix, if any bank is operation risk is 3 mean, okay, medium. Operation risk, the grade is 1 mean, okay, negligible. But this, the square root of this, instead of 3, it is 4 mean high. This you have to remember. This they will give, or sometimes you have to remember. So what is the operation risk?
What you told, sir?
Huh?
AMA.
This one, madam? AMA means advanced measurement approach. Advanced measurement approach is one of the approaches for measuring, calculating operation risk. Okay, earlier we are using basic indicator approach, then standardized approach. Now, yes, it is advocated approach is advanced measurement approach, because these are the approaches advocated under Basel III to measure the operation risk of a bank. So operation risk, so the particular bank is in medium category, mean neither low, okay, it carries a risk. Okay, and one more question I will give you. One more question. Okay, I think I will give afterwards. Okay, one more question. Also, I will list it. You see another question. The climax. Another 5 minutes, we will have a climax. Climax means we are going to finish risk management. Finish. Okay. A bank has invested. You see the question. A beautiful question. 2,400 crore in floating rate bonds. Okay. And the duration of this pool of asset is 6.34 years. The current yield is 7.2. Okay. What is the market risk for 0.5 hike in interest rates? All right. So far, we have not done anything in market risk, A simple question. They may give complicated also, but right now, don't worry about complicated. Simple question likely to be asked is, they have invested 2,000 crore. Now, the duration. Okay, now you have to remember the formula. One formula, I think you'll have discussed in your treasury. Okay, I think modified duration, the percentage of change. I will tell the formula. Actually, you have to apply the formula. Now, the yield rate, what is the market rate for hike? 0.5 interest rate hike mean the bond price, okay, hike mean bond price will come down. Please remember, I think all of you know the fundamental theory. When the rate of interest goes up, bond price will come down. When the rate of interest comes down, bond price will move up. Because the bond price and rate of interest both are inverse, opposite. Understood or not? This you will have discussed in your treasury. Now you are applying the.
Can you tell again, sir?
Madam, note down, madam. When the rate of interest or yield rate increases, note down. When the yield rate is because definitely in interview also they are asking, in every exam they are asking. When the yield rate increases, the market value of the bond comes down. The market value of the bond comes down is a theory, international theory. When the interest rate increases, market value of the bond comes down. Ulta, the interest rate comes down. The interest rate comes down. Either interest rate or coupon rate or yield rate comes down. The market price, market value or market price of the bond goes up. Understood, madam? Okay. But to measure this, how much it will go, there is a formula. What's the formula? You have to remember the formula. What's the formula? This is a formula. This formula, I think you have discussed in your treasury. The percentage change is equal to percentage change. Percentage change means what? The value of the bond, that is implied. Percentage only, not amount. Percentage change is equal to MD. What is MD? Modified duration. When D is given, modified duration easily you can find out. The modified duration into percentage change in interest rate. This much you have to remember. This formula you have to remember. Easy to remember, no? Percentage change in the value is equal to modified duration into percentage change in the interest rate. What is the percentage change? So now modified duration, how we have to find out? 6.34. I think all of you have done it in treasury. MD is equal to D divided by 1 plus R. What is R here? 7.2. 1 plus R is 1.072. The 7.2 you have to convert to decimal. 1.072. So 6.34 is the duration divided by 1.072. Then modified duration will be 5.91. You apply that. So decline in price will be, now interest rates are hiking, so bond price will come down. Simply apply. MD is 5.91.
1.07 to how we got, sir?
Huh? Madam, 1 plus R, madam. Note down the formula. One more formula. Okay, I think this will have discussed in your treasury. Note down. The modified duration is equal to, note down, madam, before you forget. Because this every year they are asking. Every year they are asking. If the question is not there, you just tell. I'm just leaking a question. Modified duration is equal to D divided by 1 plus R. This is the formula. What is D? D is duration. From duration, you can find out modified duration. What is 1 plus R? R is the rate of interest. But R, you have to convert to decimal. Here, what is the R? 7.2. That you convert to 0.072. Suppose 11% mean 0.11. 7.2 mean 0.072. So 1 plus R mean 1.072. 1.1 plus R. So the 7.2 will become 0.72. So 6.34 D divided by, sometimes they will give modified duration, sometimes they will give only D. The D mean duration. So you have to find out modified duration, then only the formula will be correct. This is the formula. So why I have put 2,400? 2,400 is the value of the investment bank is having. So the 2,400 into 5.91 into 0.5 divided by 100. Why you are putting 100? Because the 5%, 0.5%. So the 5 point, or you can put 0.5 also, you can put the percentage you leave. 0.5, if you put the 100, you need not. Okay, 0.5. 0.5 means what? Or you have to put no 0.5%, no 0.005 you have to put. Actually, or always you have to convert to decimal. So here that is why I am putting 100. So the total value will be 2,400. There will be a decline in the value 70.9. So though the portfolio is 2,400, now because of the interest rate high, the portfolio value, the value of the bond may decline by 70.92 loss. So that becomes the market raise. Now what is the capital? 70.92 into 9%, 6.38. How many of you understood? Okay, understood or not, boss?
Sir, this percentage change is equal to MD into A. This you did not use.
MD into, this is the formula, madam. Percentage change in the value is equal to this, you have to memorize.
So, but where you have used this?
Here I have used to know the percentage change. What is the percentage change? What is the value of the portfolio? I am not put percentage change. What is the value of your portfolio? 2,400. Okay. The you see percentage change. How it will change? 2,400 into MD. What is MD? That is percentage change in the value of the portfolio. I have just to put 2,400. Instead of percentage again calculating, I have straight away put the value of the your exposure. Your exposure is 2,400. What is MD? Now MD is 5.91. You have got it. What is the percentage change in the interest rate? 50 points. Sometimes they will give 0.5 mean 50 points they will give. 100 points mean 1%. 0.5 mean 50 points. Sometimes they will use the word points. 40 points mean 0.4. Okay. They will use the word points or percentage. So they have now here they have used 0.5. So 0.5 divided by 100. PNR by 100. So that this is the formula. MD into change in interest rate 0.5. So this
Sir,
will be
capital charge how we get, sir?
Which one?
Capital charge 6.38. How we get?
Market risk into 9%.
This is the risk, boss. This is the
9%
market
of 70.9.
risk weight into 9% you put. Just a 9%. Capital charge. If they ask capital charge, Otherwise, risk weight only, market risk only they are asking. Here, this is 70.92 is the market risk. You answer, you are correct. Okay. Capital charge is 6.38.
Decline in price and market risk both are same.
Which one, madam? Huh?
Decline in price and
Hello, sir.
market risk both are same.
Market risk and
Change in price, percentage change.
no, the change in price is the market risk. Yes, market risk is what? Change in the value. You are having 100 rupees gold. Tomorrow, now 1 gram gold is we'll assume 4,000. Tomorrow it is becoming 3,900. Then it becomes a market risk. Market risk is mainly because of the changes in prices, changes in the value, market value. So 107. Now the time is 10:10. You will be time for your dinner. Be relaxed. Don't worry. I am coming tomorrow also. Yes, boss. Yes, boss.
Here we don't use current yield rate.
Market risk RW is at 8% now.
Huh?
For market risk RW 8%. For market risk operation.
This is RW is 70 point. Market risk mean RW is 70.92, boss. For what? This is a different. It is not a loan exposure. It is not a loan, boss. It's a investment. It's a portfolio investment. So 2,400 you have got invested. So you may lose the market value by risk mean loss. The loss may be 70.92. Then that becomes the market risk. Market risk means likely loss on account of the changes in market rate. And what is the capital needed? 9%. To manage any loss, you have to have.
I will get takes a 9%.
Yes, 9. Just make it 9, you will get it. Just 9. You put it 17.92.
Sir, we always take 9%.
Yes, boss. Yes, one at a time. One at a time. Yes, boss.
For market risk operation is 8%.
Huh?
In morning session, sir said for operational risk and market risk 8%. A credit risk for 9%.
No. Market risk. Oh, market is 8%. They told. Is it? Okay.
No, sir. No.
Market risk is 8%. That is different, boss. I think maybe foreign currency 8%. Okay. But 9% is a normal market. 9%, boss. 9%. Okay. Understood. You understood the formula? Modified duration.
0.5% hike instead it is fall, sir. What if 0.5% fall in interest rate?
Hike mean, yes, supposing is a hike mean it doesn't become a risk. Because if there is a fall in interest rate, the price will move up. When the bond price moves up, it's not a loss for the bank. The bond price, now it is 2,400. Now it becomes 2,500. Is not a loss, is a profit. So the questions will not be on profit management. The question will be on loss management. Risk is nothing but managing a loss. So always they will tell.
Formula percentage change and decline in price are one and the same, sir.
Yes. The percentage change mean sometimes they will tell instead of hike, they will tell increase in market interest rates. Hike and increase both are same. Sometimes instead of 0.5, they will tell 50 points, 40 points,
no, sir,
20 points.
Not that. My doubt is not that one, sir. Actually, in the formula, percentage change is equal to you have written no. But while calculating a decline in price, you were writing. So I got confused.
No. Because hike in interest rate, just now you know the rule. The rate of interest increases mean bond price will decline. Never forget. When the rate of interest goes up, bond price comes down. When the rate of interest in a bond goes down, here it is going hike, increase. So the bond price will fall. That is why I have used the word decline. Because I have used the word, here I have used the word increase mean here decrease. Hike, decline.
Correct, sir. But see, when we are applying for the formula, modified duration into percentage change in interest means
percentage change, madam, maybe Percentage change may be, you are correct. Percentage change may be either increase or decrease. Formula is same. Formula
But
is
we should
percentage
include
change
that
means,
investment into MD into percentage change, sir.
yes.
We
Because
have
they
to
are
put
given the
2,400 also.
they have given the 2,100. No, straight away I have calculated. This is for 1 rupee. This is the change. Okay, 5 point is a 1 rupee, but they are already given the value of the portfolio. So the changes for 2,400 will be 70.92 crore may change. It may come down. The value of the current value is 2,400. The future value, because of the hike in interest rate, may come down by another 71 crore, may be a loss. Okay, understood? Why it's a loss? Decline in the value. Okay, yes. What is, how you got percentage? The formula is a percentage change is equal to, sometimes they will ask the word, how present rate is this one, the present value of the bond is, that is they will ask in treasury. The present value of the bond is 1,200. What will be the future price? What will be the future price? Then you have to apply the percentage. Percentage increase or decrease, either increase mean plus button you put, decrease mean minus button you put, then you get the new value after the mark. Yes, that question they will ask. What will be the price of the bond after 10 points rise in the interest, 10 point decrease in the 40 points decrease in the interest. So like that you have to. Formula is same. Understood, boss? So it is now, I can do some more, but don't worry. Anyhow, I am coming tomorrow.
Current yield rate, sir.
Which one, madam?
Current yield rate. Why they gave your current yield rate?
Current yield rate, just to, unless you give the current yield rate, no, madam, you cannot find out the duration. For calculating duration, you are correct. Why they are given current yield rate? Unless they give the current yield rate, you cannot find, they have given only duration. But how to find out the MD? The MD to find out based on the current yield rate. So 6.34 divided by 1.072. 1.07, 1 plus R. Always remember. So two more formulas you have remembered. So this will help you to do arithmetics in a better way. When duration is given, immediately come to modified duration. Unless you get the modified duration, this formula you cannot apply. What is the formula? Percentage change. It may be increase or decrease is equal to modified duration into percentage change in the interest rate. Always interest rate will be expressed in percentage. And here, what is the percentage change? Okay. Supposing, okay, I can give so many examples. Now you remember the formula, you are through. Yes or no, friends? Up to this, all of you have understood? Okay,
Sir,
because I
tomorrow we
should not.
will discuss on this topic more.
Which one, madam?
This operational risk, market risk, and credit risk.
Operational risk is?
No, tomorrow we are going to discuss more on this topic.
Yes. Another 3-4 questions are there because balance sheet management. Okay, it will also around 100 questions are there. There are also arithmetic is there. So I will come during the same 3 hour, same 3
Will you
morning.
explain vertical or horizontal also?
Yes.
Sir, this
Vertical,
one, could you please repeat tomorrow, sir? Somewhat
this,
confusing, sir.
okay. The percentage change. I'll
Yes,
give there.
could you please elaborately explain, sir?
Yes.
Steps are missing.
Again, you remember.
How
I'm
come
going to give another
the 70.92, sir?
No, don't worry. I will give again the remaining question. Only few are remaining. For example, I am going to give a question like this also. Don't worry. Okay, this is a question, operation risk, PSA. The remaining questions, I am checking how many are remaining. Because tomorrow you have this where also I am giving you models. This formula also you have to remember. Now they will not give in the exam. The where formula. Where mean value at risk. Rate of volatility into square root of time horizon. That's all. Where is equal to rate of volatility into square root. So you have to calculate first square root and before. Okay, I think all of you know how to calculate the square root in the your small calculator. Like that you have to calculate. Okay, where? Okay,
So what
rate
is
of
your
volatility.
time tomorrow, sir? What is
Tomorrow, madam,
time?
11:30 to 1, I will come. I think another subject known as, treasury
Balance sheet.
management, they will do tomorrow. No, balance sheet, I will do balance sheet management.
Yes, sir.
And the other sir will do treasury. Morning, they will come. 11:30 to 1, I will come. Then
Okay.
3:30 to 5, same timing. 3:30
Okay.
to 5, I will come.
Morning 2
Then
sessions, treasury, sir. Morning 2 sessions.
yes.
30
Morning
and
treasury. Yes. Treasury, they will give a rapid round, madam. Here, yes, because no problem. I will, last I will adjust the timing. Last I can give you more timing because sometimes, other session will interfere, no? So he has designed in such a way, 11:30 to 1, even I can go up to 1:30 also, no problem.